All right. Just a few housekeeping rules. Again, as I said, please put your mics on mute. If you have any questions, you can use the chat box, and we will then answer questions. In regards to the agenda, we are going to have the presentation first, and we're going to have 10 minutes of questions and answers. So once we have the questions and answer session, please do use your chat box and take advantage of this opportunity where we are going to be talking about trade finance or with working capital associates. All right. Federica, can you hear me?
Yes, I can. Can you hear me?
Excellent. So I'm going to introduce SheTrades and SheTrades Invest and yourself, and then we can move on to Working Capital Associates. I'll hand over the floor to you. Is that fine?
Sure, perfect.
All right, excellent. For those whose first time joining the webinar, this is a SheTrades webinar focusing on investment readiness. And under the umbrella of the SheTrades initiative, SheTrades Invest is dedicated to supporting fruitful relationships between investors and women entrepreneurs in developing markets. In doing so, SheTrades Invest addresses the sixth global action of the SheTrades initiative, unlocking financial services for women-owned businesses. What will SheTrades Invest do? We are strengthening the financial and managerial capacity of women entrepreneurs, improving their investment readiness, and connecting them to impact investors or financiers. At the same time, we connect eligible women entrepreneurs with the right impact investors. So we build their pipeline. All right. We are now starting with a new webinar series focusing on meet the investor, because many of the times women entrepreneurs do not have the opportunity to ask questions directly to investors or know exactly what is the financial instrument that they use or their offerings. So this is now our new webinar series called Meet the Investor. And today we have Ms. Federica Sambayas. She's from Working Capital Associates. I'm going to give a brief background of her before I pass on the floor. So Ms. Federica Sambayas is the CEO of Working Capital Associates, an alternative finance company specialized in short-term transactional financing for exporters or importers in Africa and Latin America. Federica is a senior banking and finance professional with over 20 years experience in originating, advising, and structuring corporate finance solutions for global clients. Federica, welcome. And we are very happy to have you here today. And we look forward to understanding a bit more of trade finance and what Working Capital Associates has to offer. So I'm going to now give you the floor, and I will change the icon onto your name for you to have the power to change the slides. So if you could introduce yourself, that would be great, while I transfer the icon onto your name.
Perfect. So thank you very much, Leticia. Welcome, everybody. I can see already a quite active chat. So I hope that everybody can hear me well. If not, please just shout in the chat. As Leticia said, the purpose of the webinar today is to talk about trade finance and how trade finance can help companies and your growth. So I will start. Let's see if this works. How do I? Sorry, Leticia.
No, it's okay. I've given you the
Yes,
right.
thank you.
Perfect.
So let's start. First of all, one first question. What does my business need to grow? And what businesses normally need is access to finance. There's plenty of studies that have been published over the years about what type of finance for what type of companies. I've decided to use these statistics from the WTO which are specific to SMEs. And it's quite staggering to see that lack of access to business finance is what is more cited by SMEs when they're asked what is actually limiting their growth. And more specifically, the access to trade finance is one of the key sub-elements of business finance that SMEs are missing. So what is it that we're talking about? What do we define as trade finance? So trade finance is nothing else than the set of financing solutions buyers and sellers to manage their working capital, manage what we call the order to cash cycle. And any instrument under the big trade finance umbrella resolves two conflicting interests. On one side, the interest of the buyer to pay as late as possible, and the interest of the seller to receive their payment as early as possible. This is typically the imbalance between the buyer and the seller in any transaction that trade finance can help to address and resolve. So we've briefly mentioned that trade finance addresses the financing gap in any order, in any order to cash cycle. What I've done here, I've tried to visually, in a simplified way, to give you an example of what a typical cycle looks like, to see where this famous funding gap is. Maybe what I can do, I can quickly define what a funding gap is. A funding gap is essentially the lack of money, the lack of cash and liquidity to do whatever is needed. So for instance, if I have a pen today and I sell it to Leticia is going to pay me in 60 days. For 60 days, I have no cash to buy other pens to sell to my other clients. On the other end, if I have some financing that pays me for my pen on day one, then I can go and use it to either purchase more supplies or to invest it in my business to support my growth. So what you see here is the typical cycle of any manufacturing. So on day one, you have your order from, and again, this is simplified. On day one, you have your order from your client, and let's assume that it takes 30 days to manufacture. So already between day one and day 30, the typical manufacturer has a cash outflow, means that they need to pay out cash to procure their prime material, their raw material, their inputs, whatever they need to perform their order. So they're already 30 days out of pockets. Then they need to ship the goods, to send them wherever their client is, which brings us to, hypothetically, 45 days. And after a short trip, on day 60, the goods are delivered. Already, the seller is 60 days out of pocket, which means that the exporter, the seller, has a 60 days funding gap that somehow they need to plug. Because, of course, during these 60 days, they need to pay for their, we've said already, their raw material, but they will also have to pay salaries. They will need to pay for their lights, for their offices. They need to find the money somewhere. Then the goods get delivered, and the same situation occurs for the importer, because now the goods are with the importer. The importer will need to pay, so the buyer will need to pay the seller, and it's their turn to be out of pocket, because they will need to sell the goods, issue the invoice, and then the goods will be paid. So as you can see, across the cash cycle, across the value chain, all the various players have different needs in terms of cash. And all the various participants to the cycle try to stretch the trade. It means that they try to improve their own working capital. So the exporter will try to be paid as soon as possible, so they will try to improve the working capital. And at the same time, the importer will try to pay as late as possible their seller and to get paid as early as possible. So everybody's losing, right? Because everybody, each actor in the cycle tries to improve their own working capital without helping the other actors. So it's a lose-lose situation for everybody, for the exporter and the importer in this simplified scenario. So if we look at something more concrete, what are we talking about, right? We've seen loads of nice arrows with days, etc. But what is it that we're talking about? Who are the actors in this value chain? I've taken an example in the agri-food sector, and again, this is simplified, to see and also to look at the two key buckets, if you like, for trade finance, the pre-shipment phase and the post-shipment phase. So if you look at the pre-shipment phase, you will see the arrow at the bottom of the graph. That is what we call the phase where the goods are manufactured, are aggregated, are organized. And you see a number of players, right? You see the providers of fertilizers, of seeds, of equipment to the farms, to commercial farms, to aggregators, to cooperatives, who in turn will need to pass it on to logistics services to go to their ultimate buyers. So the post-shipment phase is the phase where the goods have been manufactured, processed, refined, and are ready to be sold. So the order has been fulfilled, and through distribution channels, through logistics channels, are shipped, are sold. And that's the second phase of any value chain of the so-called post-shipment. It means that the goods are ready and they are shipped. And we will come across this terminology also further down the line. And it's quite important to remember these two big buckets, pre-shipment and post-shipment, because the trade finance instruments available for these two these two moments are different. Okay, so let's look at, we know that trade finance it's a financing instrument. It's a piece of finance that can be used. But how is my company today financed? What do I use? How do I pay my supplies? How do I pay my employees? How do I pay for not only for my day-to-day operations, but also for my growth, right? So normally, we're talking here about not a startup. Any company that has been trading for a while has various components in their financing structure. Normally, they start with equity, and then on top of equity, there's additional financing that can be junior or senior. And this capital structure is what we normally define as permanent capital. Why permanent? Because it stays for a long time. So let's see what are the key features of these three big groups of permanent capital. Let's start with equity. Equity is the first capital that comes in, and it's normally put in by the founders, sometimes some venture capitalists for some startup, but let's assume that it's simply the founders. The key features of any equity financing is that the shareholders have decision powers. So they own the company, they decide what the company does, its direction, and they share the profits. So any shareholder will share the profits that the company generates. And of course, they are, if you like, the longest term stakeholders, because they are there for the long run. And typically, any business that is any young business finances itself mainly with equity. Um, then junior debt and senior debt. These are both pieces of corporate finance, traditional corporate finance, that is provided normally by local banks. And they both have similar features. First of all, they are senior to equity. What does it mean? It means that in case something happens to the company, if the company has any issues and ends up in a bankruptcy, then the debt holders, so the banks, will have priority on any income that comes from the company, and the equity holders, so the shareholders, will bear all the losses. Typically, debt is interest bearing. It means that on a monthly basis or a different with different deadlines, but anyway, it bears an interest, a cash interest that needs to be paid to the debt holders on a regular basis. They have a number of covenants. So the financial agreements have a number of covenants. What is a covenant? A covenant is an obligation for the company to do something. So normally covenants are all around level of debt, level of pledges, which means how much of assets of the company can be used as collateral for added debt, and a number of ratios related to profitability and equity coverage, which means that any piece of debt, any contract related to debt normally requires that the company is very healthy in terms of their cash generation, in terms of their profitability, because these ratios are quite, in a way, are quite protective, the debt holders. And of course, they're quite, they're quite tight for the company. And finally, which is key to make a piece of debt senior secured, is secured and control over assets. Typically, what banks require is to have security and first lien on assets. And normally these are buildings, hard assets. It can be, sometimes can be cars, but most likely is real estate, which means, and again, their valuation of this asset is very protective. So the loan to asset value ratio normally is quite low. So for instance, if the collateral, so if the real estate has a value of 100, the debt given for that value can be maybe lower than 50%. It means that you have an asset which is worth 100, which generates cash, a piece of debt of about 50. And the asset, of course, is completely encumbered, so it cannot be used for anything. So normally, this is a capital structure for mid-level companies that are not too green, but that perhaps are not ready yet for different type of cheaper structures, cheaper forms of capital. If a company is green, so it's quite young, normally it will be financed mainly with equity, and then mainstream bank debt will be available normally at a later stage. So let's see how trade finance sits in this existing capital structure. Again, this is a simplification. It could be that your company today only has equity, right? So how trade finance works and how does it sit in the capital structure? Trade finance is a very flexible instrument, and it adds flexibility to an existing capital structure. What does it mean? It means that it can live together, it can supplement existing sources of capital, because it can be structured in a way that doesn't need collateral. So it's really, if you like, financing on the tap. which means that it supplements the existing permanent capital and can be used only when needed. For instance, a working capital loan or a transactional financing. Normally, it's structured to give the company flexibility during their working capital peak. So it means the period where the company sells more and has, but doesn't receive cash. This could be seasonal peaks, for instance, especially in the agri and food sector. There are seasonal peaks related to the production season, the crop season. So what working capital does, a working capital facility does, it can be drawn down during these periods for short term, for short period, just to support this working capital peaks, and then can be repaid, and it doesn't need to be utilized until the next working capital. It can be supplemental to bank financing. There's nothing that prohibits or forbids trade finance to be added to existing bank debt. And it's also very flexible in terms of how it can be structured. It can be structured to finance payables or can be structured to finance receivables, or a mix of both, right? Because if at the same time my company manufactures and sells, of course, at the same time, I am a buyer and a seller. So maybe I will need receivables financing and payables financing at the same time. It's also transactional capital. You remember in the previous slide, or actually in this slide as well, you can see that equity and debt normally is defined as permanent capital. Trade finance is normally defined as transactional capital, which means that the capital is linked to a transaction. There needs to be a sale and a purchase of goods, so that the working capital facility, the trade financing, can be utilized and can kick in. Normally, transactional finance is not available for general corporate purposes, like to buy, I don't know, chairs or desks. It's linked to transaction. It's linked, for instance, to a sale of, in our example before, of pens. So when I have a contract to sell 1 million pence, then, and I have a working capital need, that's when I can draw down and utilize my working capital facility. Normally, trade finance facilities are unsecured, which means that there is no hard asset that is linked and encumbered to secure the debt. This is very important because one of the key limitations for companies, for SMEs to grow, is the availability of collateral. Because without collateral, banks will not provide them with liquidity. With trade finance, normally there's no need for collateral, which means that this financing is very fast, right? It turns very fast. It's not permanent capital. It's drawn down and repaid, which means that it doesn't create additional leverage. It doesn't create additional debt, and therefore it does not breach my covenants, the covenants that I have under my junior debt or secured debt. The covenants are, you remember, the limitations that a company has as imposed by their banks. So now we've talked a little bit about what trade finance is, how it sits in a capital structure, and how it can support a value chain in order to cash the cycle. Let's see if trade finance is suitable to my company. And what I've done here, I've done a simplified chart to help our thinking. So the first question is, what does my company sell? Do I provide services, or do I provide tangible goods? This is very important because services are very tricky to finance with trade finance. Trade finance is an instrument that works well and works better with tangible goods. Now, it's not written in stones that that trade finance cannot be used for services, but it's more complicated in terms of structuring. So for simplicity purposes, let's focus on tangible goods. So my company sells tangible goods, yes. Do I sell or buy from an OECD country? Again, this is a simplification, but it gives you a feel for the type of countries that can be trickier. Of course, the issue is always sanctioned countries or countries that are in a particular political turmoil. We have seen a few countries recently that are in a financial and political turmoil. Those countries are very difficult to deal with from a financing point of view. So is this a key requirement that it needs to be an OECD country? No, but this is, again, it's a simplification. What is a requirement is that the country is not sanctioned, because financiers normally are limited in terms of what they can do, depending on their sources of capital. So the country, it's a yes. So let's move on. It's a yes. So do I want to be paid earlier, or do I want to pay later? What does it mean? Am I a supermarket? If I am a supermarket, I get paid immediately. So I don't need working capital. Maybe I need working capital to pay my suppliers, but definitely not to finance my sales. So the key question is there a time gap? Is there a financing gap, like we saw in the first slide, that I need to address? Then it's a yes. Do I have an established relationship with my counterpart? This is very important. Why? Because in any trade financing structure, what matters is the existing flow of goods. We've said before that trade finance focuses on a transaction, the fact that there needs to be a purchase and a sale. If I am a new company, brand new startup, and I want to sell my widgets, do I have evidence? Can I prove that I am able to manufacture them, ship them, and deliver them, and that they are the right quality required by my seller? The answer is no. So what I need as a financier is to see that there is an established relationship, which means that the trades, the purchases and sales have been ongoing for a while, to demonstrate the ability of both parties to perform on their obligation. So the ability of the seller to manufacture, ship, and meet the quality requirements, and the ability of the buyer and willingness of the buyer to pay. This is very important. And then, does my company have 3 years of financials? Now, I've used 3 years to give you a sense for the sort of the growth of the company, where the company needs to be in their growth to be the right company for trade finance. The reality is that we, for instance, work with companies that have less than 3 years of financials, maybe have 1 year. But what is key is that during this year, you've performed, you've sold and purchased, and you can demonstrate your ability to meet your obligations, and to buy and sell, and to produce, aggregate, to perform your services, or to deliver your goods at the right quality. So if all these are yes, then trade finance can be suitable to your company. Of course, this is an oversimplification. Everything will need to be analyzed, in detail, both in terms of due diligence and credit approvals, before any trade financing can be extended. So we go back to our initial slides. You remember there was an order to cash cycle. We had an exporter gap, an exporter financing gap, and an importer financing gap. And what I've done here, I've used the same graph, so the same length, with a few examples of the instruments that can be used. For instance, in the period between the order and the invoice, we can use pre-shipment financing. Remember, there were two key phases, the pre-shipment and the post-shipment. Pre-shipment means it finances goods that have not been shipped. It means that they are goods that have been ordered, they are in the process of being manufactured, they are in the process of being aggregated, but they are not ready. So this is a financing that needs to cater for the risk that the goods are actually not manufactured. So that there is an issue that the seller is not able to complete the order. So it's a specific set of financing instrument to cover the pre-shipment phase. Then the goods get shipped, so there is an invoice. The invoice means that the goods are ready. They are on a boat, on a cargo, on a plane. They are ready. At this point, a different set of instruments can be used that go under the general umbrella of receivables financing. Why? Because the invoice has created a receivable right that the seller has. And then moving on, when the goods are delivered, it could be that there is another time gap. Oftentimes, even when the goods are delivered, the terms of the sale are with, I don't know, 30, 60, 90 days payment from delivery, which is a long time. So an instrument that can be used this is post-shipment, because the goods have been shipped, they now have arrived. So a working capital loan can be considered. Again, this will be short tenor. It will roll after it's been utilized for the required tenor, and it can be withdrawn and returned as many times as needed. And then finally, it starts all over again on the other side. You remember there was the exporter on one side and the importer on the other side. The importer has the same needs. So the importer now becomes the seller, and they might need to finance their own payables, which is the invoice that the seller has issued that now needs to be paid. All these instruments address the conflict that we looked at the beginning, the conflict between exporter and importers to stretch their respective trades. With trade finance instruments that address this imbalance, this conflict, companies can manage efficiently their working capital, and it's a win-win situation for both the importer and the exporter, because they both have filled their financing gap, and they have no need to stretch the trade and to create conflict with their counterparts. Okay, so let's try and summarize. We've discussed many things, many concepts. Let's try here to summarize what we're talking about. What are the key criteria on the transaction side and on the facility side? How does the transaction needs to look like, and how the facility looks like? So on the left-hand side, you will see a summary of what we just discussed with the graph with the yes and no, right? The goods are tangible, they flow into non-sanctioned countries, and the trade flows are recurring. Let's look now at the right-hand side, where we have the key facility criteria, which means how does the facility look like, right? Which we've touched upon so far. So the financing is transactional, which means that it needs to be used for a transaction. It cannot be used for general purposes. It's short tenor. This is very important. Trade finance is a short-term piece of financing, which means that whilst the umbrella facility can be maybe 1 year long with a 1 year tenor, the drawdown period is limited to a short term, which normally mirrors the tenor of the underlying transaction. So if the underlying transaction has 60 days to be paid, then the financing will mirror these 60 days. So the 60 days of my sale will be the same as my financing. That's very important to differentiate trade finance from bank finance, from traditional bank loans. And then the structure is financial. I can speak for myself here for the way we do business. As you can see, I've said we do not take ownership of the trade finance is a very broad definition. It can be done in many different ways. The way we've described so far and the way we do it, we like to do it on a purely financial basis, which means that we don't like to take ownership of the goods, meaning that I buy the goods from the seller and I sell them to the buyer. This is one way to do trade finance, which is fine. But the way we do it is purely financial. So we look at the financial strength of the various players, and we structure our financing.
Hi everyone, can you please mute your mics in order to have a smooth session? Thank you. Federica, you can continue.
I think I'm going over time, so I will go a bit faster on this section. So how do we get there? We understand what trade finance is. We understand how it sits in my capital structure. We understand how the financing looks like. How do I get prepared? What documents? What needs to be ready for a financier to look at my company as a potential borrower? So you've got four key buckets: commercial, financial, corporate, and know your client, the famous KYC. So commercial documentation is pretty straightforward. It's all around how you do business. So supply contracts, orders, executed orders, and the payables and receivables ledger to see how your company does business from a commercial point of view. Financial information, we need to see how your company is doing from a financial point of view, from a cash flow, P&L, and balance sheet. So management accounts and 3 years of full accounts. Again, 3 years is a ballpark. It can be less, but there needs to be solid financial information to allow us to make a decision. Corporate information, very important. We need to know who the shareholders are. We need to know that the corporate has been established, is meeting all their regulatory obligations. It's registered with tax. It's registered with the relevant bodies that are in charge of companies' registrations. And last but not least, very, very important, know your client. This is crucial. This is valid for any financial institution in the world, bank, non-bank, anybody. We need to know who our client is and how we do it. We need to have passport copies, proof of addresses. This is very important because we are all together in the fight against money laundering, against terrorism, against crime. And whilst banks are the first sort of line of defense, any alternative investor like us need to play their part. So this is the preparation. These are the documents that as a company you need to have ready to share with an investor. In terms of process, how long does it take? It depends. How long is a piece of string? It depends how ready the documentation is, how easy to understand it is. So if you start from your need, right, we will analyze your goods and country, currency of the trade, the size. Currency is very important because trade finance, we're always talking about importers and exporters. So it is normally a main currency. Local currencies are very difficult to do for international financiers like us. They're more suitable to local banks. So if all these things, if the preliminary due diligence is satisfactory, normally an initial proposal is put forward. This can take as long as as short as a week if all the documents are in order and easy to understand. The initial proposal looks like a non-binding term sheet with all the key information, the structure, the tenor, size, commercial and financial terms. If the term sheet is satisfactory and there is an initial approval by the company, a complete due diligence needs to be performed, which includes a review of your documents, financial review, KYC, and site visit. If the complete due diligence is the full due diligence is satisfactory, then we move to credit committee and the facility is approved or not approved. If it's approved, it moves to legal documentation. We use standard documents like any other financier. So the duration of the negotiation really depends on the borrower. The documentation normally is quite straightforward. So the legal documentation stage, again, can be as short as a few days. Then if everything falls into place, we proceed to fund. And I stop here, I pause here. I put here my address, my email address, for any follow-up questions, and I will leave the floor to Leticia to take it from here.
Excellent. Thank you so much, Federica, for the insight on trade finance. Everyone, this is your chance to ask any questions in regards to trade finance or working capital to Federica. And I think this is more relevant for those who are exporting. And we do have two questions from Ms. Ashwani. And they are, could this be defined as product manufacturers, while there could be alternative financial sources such as grants and fund programs? This, I believe, was in the beginning of the presentation, in the slide of manufacturers. She's asking whether this could be defined as products or manufacturers. Ashwani, would you like to elaborate? You can unmute yourself to talk to Federica.
Are you yeah? Hello.
Yes, I can hear you.
Basically, the question is that these are product manufacturing sectors wherein agro processing products could be created or ICT products could be created. But there could be alternate financial sources also for funds and grants programs, fellowships, scholarships. Could that also be classified as trade finance?
It's a very good question. No, so grants. It depends who gives what, right? So grants normally are free money. So they give you a grant and it's free money. Normally, grants are given by multilaterals, by supranational organizations, maybe sponsored by the UN or sponsored by governments. And the purpose of grants is to, as the word says, to grant some liquidity to certain applicants. Funds programs, I'm not sure I know, I understand the question, but basically what trade finance is nothing else than a debt. It's debt, it's a loan, right? That is a short-term loan that caters for very specific requirements for sellers and buyers. It cannot be, it's in a different bucket from a grant because a loan is not free money. It needs to be repaid and it bears an interest. So there are two different sources of funds.
Excellent. Is there anyone else who has any questions regarding trade finance? Federica, could you tell us, what do you notice that entrepreneurs lack when dealing with trade finance, post or pre-shipment? And what do you look for in an entrepreneur in terms of their behavior? Because this is one of the things that we did talk about.
So let's start from the last question, because I think that could be quite interesting. So in terms of behavior, the first thing that any financier will look for is professional behavior. And professional behavior is very easy to spot. It's about responsiveness, right? Ability to respond accurately and efficiently to questions. Ability to provide information, financial and commercial. Having the ability to follow up to any further questions. I have examples in my professional life in which we did due diligence, we negotiated, we sent out a proposal. So we dealt with this particular entrepreneur for a while. We sent out a proposal and this person just disappeared. She was just not replying anymore. Nothing bad happened to her. She just stopped engaging with us. So professional behavior means responsiveness, and which means if something has changed, just let us know. Just let the investor know, and we will take it from there. If the situation has changed and the financing is no longer required, that's fine. It happens. But it's the professional behavior is 50% of the war that you can win. Because the other 50% is, of course, the technical elements, so the credit analysis, the financial analysis, the structure. But a professional behavior will help a financier to trust the borrower, especially in times when things are dire. If there is any issue, right, you want to be lending to a borrower that you can trust, that you know will do whatever they can to make you whole, so to give you back your money. And then the first question, sorry, Leticia, can you repeat? What's the first question?
My question was, what have you noticed that entrepreneurs lack in regards to their documentation?
Yeah. So normally there are two key things. First one is actually the knowledge that trade finance exists. So that's why this webinar is, I think your initiative is fantastic. Because what often entrepreneurs lack is just the fact that trade finance is available, and normally they end up financing their working capital with equity, which is a very expensive way to finance. And what they lack, the second thing, is usually the financial rigor, which means having everything ordered, especially their supply chain, their procurement, and their sales, understanding who they are buying from, how much, what price, and when they're paying them, and who they're selling to, how much, what price, and when they get paid. So financial management, really, supply chain management.
Perfect, thank you. We have a question from Ella from Nigeria, and she says, I do mass production of uniforms, t-shirts and bags, and need to buy lots of automated industrial machines to meet my orders. How does one shop for an investor, and can an investor give working capital or just equity? And then another question is, can an investor invest into industrial machines acquisitions?
Okay, so there are various questions here. So let's start with the easiest one. Can an investor finance you? Yes, of course. You buy industrial machines, so you need to finance your machines and pay them bit by bit. This could be done in various ways. Trade finance, the way we've described it, so the transactional finance, is not necessarily the best instrument, because what you need is the ability to pay bit by bit. So what would help you to do that is a corporate loan rather than a transactional loan, corporate loan that you will pay gradually. And that can be in various forms, can be leasing, for instance. I don't know if they do leasing for industrial machines, but something similar to leasing. Equity, of course, you can use equity. Equity is can be used for anything. You can raise equity and use it to buy makeup. Doesn't matter. What is important is, well, I'm joking here. That's not true. You need to use it for corporate reasons. But the important thing is that if you get equity, you will lose control. Whoever holds your equity will have decision power together with you, depending on how much, on what percentage they have. They will be part of the group that makes decisions. So it would be a very strategic decision to have an equity investor to come in to support your purchase of machineries. I would strongly suggest to use corporate financing for that.
Excellent. And then we have a question from Jesse. How does one start a working capital financing business? Is there a model one can replicate? I see that as major challenge in my country. Okay, I think she has quite a challenge with working capital.
So do
And if
I
she could
understand
replicate it.
correctly that the question is around becoming financier? Is that
I
correct?
believe so. How does one start a working capital financing business? Is there a model one can replicate?
Yes, of course you can. Working capital is, again, it's debt, it's a loan. So there are plenty of models. There are plenty of ways. The key is, number one, to have the capital to lend, because what you become a lender. So you need to have capital to lend, and you need to meet the regulatory requirements in your country to be a lender. I think in terms of models, it's how long is a piece of string? It's really about how can I lend in my country? What regulatory requirements do I need to meet?
Excellent. Federica, you are fading a bit.
Can you hear me better now?
Much better, thank you. We also have a question from Pretty. She says, is there any trade finance for setting up your operations in another country? And we also have one from Esther saying, can one get startup capital if they have a viable project?
Okay. Startup capital for projects is normally in the form of venture capital. So it's not trade finance, but it's done by different type of investors. Investors who provide equity, and they are normally the first to provide equity are the so-called seed investors. You have angel investors, then you have venture capitalists. So to start up a business, what you really need is equity. And then the other question, sorry, I saw it. Is there any trade finance for setting up your operations in another country? I'm not sure I understand. Are we saying, is there any trade finance available to set up operations in another country? Is that the question, Preeti?
Hi, Pretty, could you...
Yes, okay.
Yes, okay, there we go.
So to set up operations, what you need is permanent capital. You need capital to rent the offices, hire people, pay the bills, and all the related payments that you need to set up an operation in another country. Trade finance is really, as the word says, related to trades. So when you start trading and when your new operations start trading. So again, startup operations or to start up a company, traditional capital is what is more suitable. There's no trade yet.
Perfect. And we also have one question from Miss Kaya. She's asking, which countries or continent does your firm deal with? You mentioned Africa, South America. Are there any other continents?
Which country do your firm deal with? Okay, we mainly deal with goods that move, that are sold and purchases between Africa and Europe and the US, and also for Latin America. So South America going from South America into the US or Europe. So these are the traditional flows. In terms of what trade finance can do, I'm speaking about us, my firm. What trade finance does, there are no limitations for countries. The only limitation that we all have, majority of us, of financiers have, is sanctioned countries. For the rest, it depends on focus and specialization of various firms. There are firms that are specialized in the Asian continent, firms that are specialized for other continents. So it really depends on the lender and their geographical focus.
Okay, and then we have a question from Yumi. Would you be able to provide trade finance for movements of goods?
In the sense of, so not sale, just a movement? I'm not sure what does it mean, movement?
When you mean movements, are you talking about sales of exporting? Could you please just clarify that?
Sales for Africa to Mexico. Yes, yes. So again, it's all subject to reviewing the terms of the specific transaction. But in principle, yes. If it's tangible goods, if they are non-controversial goods, so it's not, it's regular goods. Agri products. Okay, perfect. So agri products from Africa to chili pepper. Yes, yes, we can do that.
Excellent.
So another question.
Thank you so much, Federico. We are at 5 o'clock. I can take maybe another 3 more questions, and then maybe we'd have to end the session. And you could have.
It was Jesse asking, I think. Jesse was asking. I did not hear the response to my question.
Hello, I'm Ashwini.
Sorry, who is this?
I'm Ashwini here. I have a question.
All right, Ashwini, you can ask your question, but please use the chat box next time.
Yeah. Basically, in case there is a certain product of ICTs and research areas which are created and are available right now, and if there is a requirement from OECD countries for these products, would these products which are required by the OECD countries be provided as call for opportunities in their OECD websites?
I cannot answer for them. What I can tell you is I'm speaking for my firm again, one of the things that we look at is which countries we're dealing with. And as a good proxy for countries, we use the OECD countries. I don't know if there's anything specific on each country or on an aggregated fashion somewhere else that I don't know.
Excellent. Federico, we have one more question and then we're going to end the session. And this is from Kezia. Would you provide finance for importation of goods from Africa?
So goods going into Africa, because import from, I
Africa.
imagine it's export, right?
I would think so too. Or it would be, let's say, a European country importing from Africa.
Importing from Africa, yes. So if we have a European country buying from Africa, that would be one of our key flows that we can finance, yes.
All right, excellent. Everyone, thank you so much for joining this webinar. We will be communicating the next to you shortly. Federica, do you have any final words in regards to trade finance and the working capital associates before we end?
I think, first of all, thank you very much for all the wonderful questions. You've all been very attentive and great questions. So I think two final words. Trade finance is a wonderful instrument that really can help entrepreneurs to grow because it's very flexible. And as far as we are concerned, we want to work with a gender focus. So any of you who wants to have follow-up conversation, I'm very happy. And I can see many attendees have asked to have the slides. Letitia, maybe you can elaborate on the next steps and how they can get hold of the slides.
Yes, of course. As for those who are who attend normally, like Ashwini, thank you so much. We will send the slides in PDF after the evaluation form. After this webinar, we will send an evaluation form. Once we receive that from all of you, we will send the PDF and the link to the webinar. So you will be receiving it.
Perfect. So thanks, Letitia, for organizing. Thanks, everyone, for staying so late. I know for some of you it's quite late. Wonderful to meet you all virtually and hope to do business with you all. Thank you very much.
Excellent. Thank you so much, Federica. And as I stated before, we will be sending out evaluation forms. Please do fill it out and we will send you the PDF and the webinar link. We will also communicate with you the next Meet the Investor webinar. So please be attentive to your emails. Federica, again, thank you so much and we will be in touch.
Thank you. Bye-bye, everyone.
Bye, bye everyone.
Bye.
Ciao.
Bye. Bye.